Hello everyone, welcome back to my channel. Have you ever come across the capital adequacy ratio? If you have ever been through a bank's financial results, then you would have definitely come across this term. What exactly is the capital adequacy ratio? How is it useful to an investor or a depositor? Let's find out. I will give you a brief introduction of the balance sheet before starting this video. A balance sheet is a financial statement that has two parts, assets and liabilities. Assets are valuable things that are owned by the company. They are rights of the company. Liabilities, on the other hand, are obligations of the company, that is, the amounts the company has to pay to others in the future. Liabilities could be further classified into two types. Shareholders' funds, that is, the capital contributed by the owners of the company, and outsider liabilities like creditors, bank loans, etc. Shareholders' funds and outsider liabilities are used to finance the assets of the company. For most businesses, a major part of the liability side is shareholders' equity. Whenever the company suffers a loss, the shareholders have to bear it, and their equity value comes down due to the loss. Now, for a company that doesn't have too much debt, that is, outsider liabilities, the creditors are generally safe because the losses will be absorbed by the equity and it will act as a cushion that protects the creditors from losses. In case of a bank, its job is to collect deposits and give out loans. The difference between the lending rate and the deposit rate is the net interest margin, which forms the income of a bank. Now try to visualize a bank has shareholders' funds, that is equity of rupees 10. It has taken deposits of rupees 90. Therefore, the bank's total liabilities are rupees 10 plus rupees 90, that is rupees 100. Using this money, the bank has given out loans of rupees 100. So, the assets of the bank are rupees 100. The formula of capital adequacy ratio is Tier 1 capital plus Tier 2 capital, the whole divided by the risk-weighted assets of the bank. In this video, I want to focus more on the concept of capital adequacy ratio. So I will discuss Tier 1 and Tier 2 capital and risk weight in a separate video. For the time being, you can understand the capital adequacy ratio as the capital of the bank divided by the total assets of the bank. In our example, the bank had given out loans of rupees 100, that is, it had total assets of rupees 100. It had shareholders' funds, also known as capital, of rupees 10. So the capital adequacy ratio of the bank was 10 divided by 100, that is 10%. Now that you know how to calculate the capital adequacy ratio, I will like to discuss what exactly is its importance. Remember, unlike other businesses, a bank has a major part of its liabilities in the form of deposits, that is, outsider liabilities, and a smaller part in the form of equity shareholders' funds. You also know that losses of a company have to be borne by the equity shareholders so that the creditors of the company are protected. Let's say out of the total loans given out of rupees 100, 15 rupees loans are defaulted. That is, the borrowers refuse to pay back the money to the bank. Due to this, the bank will suffer a loss of rupees 15. However, its shareholder equity is just rupees 10. Even if the entire shareholders' funds of rupees 10 are written off, still the bank has losses of rupees 5 and there is no one left to bear it. Out of the 100 rupee loans, the bank received just rupees 85 as 15 rupees was defaulted. However, the bank has deposits of rupees 90. How will the bank repay the depositors if it has just rupees 85 left? So the 5 rupees loss will have to be borne by the depositors because the shareholders' funds is already zero and the bank no longer has cash. The bank is insolvent. Here comes the role of capital adequacy ratio. RBI has made it mandatory for banks to maintain a capital adequacy ratio of at least 9%, That is, for every 100 rupees of assets a bank has, it has to maintain equity capital of rupees 9. This will ensure that in case of losses, the bank will have enough buffer so that the depositors are safe. Higher the capital adequacy ratio, better it is. Some well-run banks in India have capital adequacy ratio of 15 and 16%. For an investor, it is very important to check the capital adequacy ratio before investing in a bank. If the capital adequacy ratio is too low, then the bank runs the risk of becoming insolvent. In the past, a few banks have run into trouble because their capital adequacy ratio was too less, and so RBI announced a moratorium. For a depositor, it is even more important to check the capital adequacy ratio because if they put their money into deposits of a bank that has a very low capital adequacy ratio, then their deposits could end up in trouble. As long as the bank has a high capital adequacy ratio, there is a cushion that protects their deposits. So, the capital adequacy ratio is a crucial ratio for investors and depositors. If you have any doubts, then feel free to mention them in the comment section. I would be glad to answer. If you have any video suggestions or you want to discuss anything with me, then you can connect with me on social media. I've put the links in the description box. If you like this video, please give it a thumbs up and subscribe to my channel for my upcoming videos. Do share it with your friends and family who might be interested in finance. Stay tuned. Thank you.